let's say that you want to sell your company. You're selling your construction company. What exactly are you selling? Because just a few days ago, I had a conversation with someone who is trying to sell a construction company. And there is even a buyer on the table. But what he's saying is that this person is lowballing him, that they are just buying it very cheaply. But what I was very quick to realize is that while this person wants us to believe him that the value of the company is high, there is no documentation that actually proves that this business is valuable. This is the person who declares what they want to declare on their tax books. So this person wants us to accept that the reported revenues are not the actual revenues. They want us to say that and to accept that the reported profits are not the actual profits. Well, that is a sign of a business that is not valuable. Because if you're not there, then how are we going to guarantee those things that you say that are there in the business? Where is the customer flow? Who are the people that work in this business? So quickly you realize that this is not an actual business. This is someone trying to sell you a piece of registration paper, a document. That's the only thing that this business is. It is just that certificate of registration and the level of project that they are allowed or licensed to partake in. That's the only reason someone can buy this business. And that is exactly the only thing that this person is buying. But if you want to sell your business, there are actually 4 things that are actually valuable in a business. And if you take, for example, 100% of your business valuation, let's say it is 10 million, almost 50% of that amount is going to come from the one thing that is important, and I call it the customer acquisition system. If we do not have a way of knowing where your customers come from, when they come, how they are attracted, how they are nurtured, how they are converted into customers. If we don't have that, 50% of the business is knocked down. We are now at 5 million. From 10 to 5. Because now we are gambling. We don't know. Most likely your business is relying on referrals. Referrals means it is you as a person. And you as a person, you're not a business. You're just an individual. Things happen. When you go out there and maybe something bad happens to you, and we do not hope that it does, but things do happen, that means that your whole lead pipeline is gone. Our ability to attract customers is gone because you are not there. So 50% goes. The next one is that customer delivery system. If you do not have proof that you have a very reliable customer delivery system, another 20% of your business valuation goes out of the window. Because we want to see a very well documented system of how you serve your customers. That these are our customers. We have 10 active customers, we have 20 active customers, we have 5 returning customers, you have a very simple way of identifying each and every aspect of that delivery system, and you have documentation for it. Don't tell us that it is in your, like it's here, like if maybe someone works with you for a year or whatever, you can give that person that knowledge. No. The value of your business goes down dramatically when you don't have something that can be proven, something that is reliable, that can be relied upon by someone else outside the company to come and implement it, and the customer will be happy. That thing that you sell as a business, these are the assets, including and not limited to assets that are involved in these 2 things. For example, websites are included as valuable items, social media platforms, owned media platforms and channels, They are considered part of your valuation as a business person or as a business. Machinery, equipment, tools, and the last one is contracts. So if you have, for example, contracts worth this amount of money and this has been paid, this is yet to be paid, these are the kind of things that these are expectations. So all these assets, they are also included in your valuation. So like I said, most of these things are actually useless because if they are not actually in your business, most likely they will be auctioned out at a fraction of the cost. So usually this one is not a huge part of your valuation as a business, actually as a construction business, because almost of these things can actually be leased out when we are serving customers. And if the assets are not really assets, if they are not valuable enough, most likely they are not going to be a huge factor in your valuation. The other one is reputation. If you have a bad reputation, if, for example, your company is considered damaged goods, for example, it has done those contracts that I say that they are maybe that are not so straightforward and they are used, maybe there are dark spots about your business in the past. Maybe you have been involved in some bad dealings. Some of them, maybe a building that you did maybe collapse and such things. Your reputation is also part of your business valuation. And the last one is verifiable business information. And I said before, if we cannot have those verifiable documentation of things, if you are saying you have a contract with someone, how enforceable is that contract? If they are, for example, contracts with key members of your team, of your delivery system or your customer acquisition system, how watertight are those contracts? Are they enforceable contracts? Can we verify your revenues through bank accounts, through bank records? Can we verify your profits and costs and the whole thing through audits and audit reports? If we cannot do that, then you're only selling a piece of registration document. If your business doesn't have these things, I don't think you're preparing it for a sale. You most likely are not going to be able to sell because you cannot sell yourself. You cannot package yourself and sell yourself. You package the business so that, and its systems so that it can exchange hands. So thank you for watching, and if your intention maybe is to get out of the business by selling it. For example, most people that retire in the construction industry end up selling their businesses, but most of them don't have actually a business that can be sold. By the time they are done, they want to retire, it was just them. It's at that time that they realized that it was just them. He was an engineer, he was a structural engineer, he was an architect, he was a surveyor. That is it. And it was a solo practice. And that was all you did. So for you to transition from that solo practice or turning that solo practice into something valuable that you can actually sell and retire or maybe change hands, some people you can actually sell just part of your business. You don't have to sell out of it. You can sell maybe 70% or the controlling stake to someone else, and you are left with maybe 30% where you continue to participate in profit sharing and such things. You can even retire early. But unless you have created these things, that is going to be very difficult.